Welcome to the Pro Ticker Deep Dive.
It is, well, it's certainly a day to be diving deep. Though honestly, judging by the charts this morning, I think most of the market feels like they've been thrown into the deep end without a life vest.
Yeah, that is definitely putting it mildly. If you are listening to this right now, you already know exactly what day it is. It's Monday, February 23, 2026. And if you've dared to look at a screen or a phone or honestly even a basic news ticker today, you know that the markets are just a sea of red.
Total bloodbath.
Right. But even calling it a sea of red feels like, I don't know, a cliche at this point. This isn't your standard market correction. This looks like a crime scene.
It really does. It's the kind of day where you stare at the terminal and you genuinely think that the data feed must be broken because the numbers are just moving way too fast.
Exactly. I actually checked the Fear and Greed Index right before we sat down in the studio, and it is sitting at a 5 out of 100. A 5.
Wow. We haven't seen a 5 since the darkest days of the 2022 contagion.
That is technically extreme fear territory, but honestly, even that label feels totally insufficient for what we're seeing. It's pure panic.
Yeah, a reading of 5 basically means complete market paralysis. It means literally nobody wants to touch anything with a risk profile attached to it. It's not just fear anymore. It's a complete and total absence of conviction from buyers.
And the sheer velocity of this crash has been breathtaking. We aren't talking about a slow bleed over a few weeks where you have time to adjust your portfolio or hedge your bets. We are talking about billions of dollars in market capitalization completely wiped out in a matter of hours.
Poof, gone.
The sentiment shifted from this euphoric institutional adoption is finally here to get me out at literally any price in the time it took me to go grab a coffee.
It is a textbook liquidity crisis.
Yeah.
But the triggers this time around, they are a really fascinating cocktail.
And that is exactly our mission for this deep dive. We are going to completely dissect this perfect storm, and I really don't use that term lightly today. It genuinely is a convergence of three massive vectors hitting all at once.
All right, you've got the macro geopolitics with these sudden new tariffs.
Which we will get into, especially that weird Greenland aspect, because that is just bizarre.
Highly bizarre. Plus, you've got domestic chaos with the Federal Reserve rumors swirling, and then you have these brutal underlying market mechanics, specifically the liquidation cascades and the auto deleveraging that just poured absolute gasoline on the fire.
Precisely. It's super easy to just look at the price and scream, but our job today is to peel back the layers for you. We need to look at exactly why the support failed. We need to look at Bitcoin losing that critical $65,000 safety net.
And the XRP paradox.
Yes, the XRP paradox. Why objectively phenomenal news is somehow resulting in a catastrophic price collapse. And we definitely need to get into the weeds of what is happening, or I guess what is failing to happen in Washington with the Clarity Act.
So let's just not waste any time. Let's get right into the anatomy of this crash. What exactly just happened? Because looking at the raw numbers, it's staggering. The total crypto market cap dropped approximately $100 billion.
In a matter of hours.
Exactly. That is the GDP of a mid-sized nation just completely evaporating from the ledger.
And Bitcoin, the king, the supposed flight to safety asset of the space, plunged right below a very significant psychological and technical level. $65,000. It touched lows around $64,384. And I actually saw some wicks on specific exchanges that went even deeper than that.
Yeah, that 65K level was highly critical. It was the floor that every single algorithmic trader was watching. Once that broke, the machines basically took over. And you know the old saying, if Bitcoin sneezes, the altcoin market catches the plague.
Which brings us to XRP. It seems to be the absolute epicenter of the volatility this time around. I was watching the charts live, and it flashed down to $1.33 on major exchanges like Binance. But the crazy part is, that is actually the good price, isn't it?
Relative to the rest of the fractured market, yes. This is where the flash crash aspect really shows its teeth. On smaller, far more illiquid exchanges, we saw violent wicks down to as low as 77 cents.
77 cents. That is less than half of what it was trading at just days ago. That is pure insanity.
It is, and it highlights a massive systemic failure in market efficiency. Normally, in a healthy market, you have arbitrage bots.
Right.
So if XRP is $1.33 on Binance and 77 cents on some smaller exchange, a bot instantly buys the cheap one and sells the expensive one, which equalizes the price across the board in milliseconds.
That's market mechanics 101. So why on earth didn't that happen today?
Because the liquidity was completely fractured. The selling pressure was just so incredibly intense, and the order books were so thin on the buy side that the bots literally couldn't execute.
They just stalled out.
Basically, yes. They couldn't find the necessary liquidity to close the loop. So you had these massive, terrifying disparities. On Bitstamp, it somehow held around $1.58, while other markets were outright collapsing. That tells you the internal plumbing of the system broke down.
And it wasn't just the trading bots that were paralyzed. I was reading reports from regular retail traders saying their screens were just freezing up. They couldn't place orders. People were desperately trying to buy the dip at those lower 77-cent prices, thinking they were getting the steal of a lifetime, but the order simply wouldn't execute.
That is the ultimate hallmark of a liquidity crunch. The exit door becomes tiny, and absolutely everyone tries to run through it at the exact same second. When that happens, the exchange infrastructure buckles, and when you can't buy, the price has zero support. It doesn't just trend down, it teleports down.
Teleports down. That's a great way to put it. And Ethereum certainly wasn't spared either. It dropped nearly 6%, cleanly losing the $1,900 level to trade near 1860.
Which is a massive psychological blow for ETH holders. But again, the real story today isn't just the percentage drop, it is the sheer violence of the move. And that violence is exactly what triggered the liquidation tsunami.
Okay, let's talk about those liquidations, because this is where the leverage comes into play. And the numbers here are just eye-watering.
Total liquidations across the entire crypto market hit nearly $873 million today.
Wow.
That is nearly $1 billion of trader capital forcibly wiped out. But here is the key stat that really tells the story of where market sentiment was at. Over $787 million of that came from long positions.
So almost $800 million was actively betting the price would go up.
Exactly. The market was overwhelmingly positioned for a massive breakout. Traders were hugely over-leveraged, completely expecting the institutional narrative, the ETFs, the regulatory hopes, to carry them higher. They were leaning all the way forward, and the rug just got violently pulled.
And for XRP specifically, I saw a metric showing it was the largest long liquidation event since November of 2025.
Roughly $40 million completely wiped out in just 12 hours. That is a ton of bullish sentiment getting flushed straight down the drain. It wipes out all the retail dip buyers who are using margin. They get margin called, their positions are forced sold by the exchange, and that automated selling drives the price down even further, which then triggers the margin call for the next guy down the ladder. It's a vicious cascade.
Okay, so we know what happened. It was a violent, leverage-fueled flush driven by painfully thin liquidity. But markets don't just decide to jump off a cliff for absolutely no reason. There is always a catalyst. Let's look at the macro trigger here. What pushed them?
This is where that perfect storm analogy really holds up beautifully. You have to look directly at the White House. President Trump announced he is officially raising global tariffs to 15%, up from the previous baseline of 10%.
And markets hate tariffs. That's just a universal economic rule.
Markets hate uncertainty above all else, and tariffs are this nasty double-edged sort of uncertainty. First off, they instantly disrupt global supply chains. But much more importantly for asset prices, tariffs bring inflation.
Right.
If you slap a 15% tax on goods coming into the country, the companies don't just eat that cost. Those goods get more expensive.
And if goods get more expensive, the everyday consumer pays more at the register, which is the literal definition of inflation.
Precisely.
Yeah.
And the immediate reaction across the board was a severe risk-off environment. Investors fled speculative assets, and let's be totally honest here, despite all the regulatory progress, crypto is still treated as a high-risk, speculative asset by the big Wall Street money. They ran for safety, they ran to cash, to bonds, to anything that isn't inherently volatile.
I saw some very specific mentions in the morning reports about rising tensions with the European Union, and this incredibly specific, almost weird detail about Greenland.
I know, it sounds almost absurd, doesn't it?
Yeah.
Greenland trade disputes.
It sounds like a plot point from a mediocre political thriller. What exactly is going on up there?
It's almost certainly tied to strategic resources.
Mm-hmm.
You have to remember, Greenland is incredibly rich in rare earth minerals, which are absolutely critical for modern tech infrastructure, EV batteries, and national defense.
Oh, I see.
If there's a sudden geopolitical dispute there involving the EU and the US, it implies an immediate bottleneck in the global tech supply chain.
Which instantly hurts the big tech stocks.
Exactly. And crypto correlates very tightly with tech equities. But it also adds this thick layer of geopolitical unpredictability. If the US and the EU are suddenly fighting over Arctic trade routes and rare earth minerals, the baseline stability of the global trade order is in question. Markets absolutely despise that kind of systemic risk.
But the bigger domestic economic issue is the inflation implication, right? Because if inflation starts ticking back up due to these 15% tariffs.
Then the Federal Reserve is completely trapped. This is the crucial link you have to understand. The market was eagerly pricing in rate cuts for the rest of the year. They wanted cheap money back. But if tariffs spike inflation, the Fed mathematically cannot cut rates. In fact, they might have to keep them higher for much longer to fight off that new tariff-induced inflation.
And high interest rates are basically kryptonite for crypto.
They are kryptonite for all non-yielding assets. Think
Yeah.
about it. If I can get a guaranteed, risk-free 5 or 6% yield from a U.S. Treasury bond just because rates are high, why on earth would I risk my capital on Bitcoin? High rates systematically suck the liquidity right out of the crypto ecosystem.
But the Fed has its own massive problems right now, doesn't it? It's not just about the macro rates and the inflation math. There's this crazy rumor circulating today that feels much, much darker.
The Fed independence crisis. Yes. This is a massive story that is actively spooking the traditional finance world just as much, if not more, than the crypto world today. There are very persistent, loud rumors of a formal criminal investigation into Fed Chair Jerome Powell.
Which is totally unprecedented. I mean, we've obviously had political pressure on the Fed before from various presidents, but a criminal investigation.
It's the nuclear option. And honestly, whether it is actually true or not almost doesn't matter at this stage. The rumor itself is doing the damage. It creates immense institutional friction. Global markets rely entirely on the Fed being a steady, highly predictable hand. They have to be an independent arbiter of monetary policy.
Right. The whole foundational idea is that they make decisions based on economic data, not on who is in the Oval Office.
Exactly. But if the Fed chair is suddenly under criminal investigation, or even if there is just a strong perception that the executive branch is trying to aggressively dismantle the Fed's independence through legal threats, monetary policy becomes wildly unpredictable. It becomes fully political.
And historical unpredictability usually drives that flight away from assets denominated in dollars, doesn't it?
Long term, yes, absolutely. If you destroy faith in the central bank, you eventually destroy faith in the currency itself, which theoretically should be massively bullish for Bitcoin.
Right, the whole digital gold narrative. A hard hedge against central bank failure.
That's the core thesis, sure. But in the immediate visceral moment of market panic, it actually causes cash hoarding. People do not buy Bitcoin when they are terrified of an imminent systemic collapse. They buy U.S. dollars so they can pay their immediate debts and close out their leveraged positions. It's the dollar milkshake theory playing out in real time. Everything else gets aggressively sold to buy cash.
So we are essentially seeing a politicized dollar playing out live.
That is a very astute way to put it. Market fundamentals are being temporarily completely replaced by geopolitical theater. Crypto isn't moving today because of a cool protocol upgrade, or because a blockchain got a little faster, or because of organic adoption metrics. It is moving purely because of a White House press release and a vicious rumor mill in Washington.
It's incredibly frustrating for the people who are in this space for the actual technology. You spend years building robust systems, and then a random tariff announcement wipes out 20% of the network's value in an afternoon. But look, we have to deal with the reality of the market in front of us. Let's look back under the hood at the mechanics again. You mentioned earlier that the exit door was too small, but looking at the on-chain data, it really seems like some people knew exactly where the exit was well before the fire alarm even went off.
Ah, you were referring to the whale exodus.
Exactly. The on-chain forensics are showing some token movements that look very, well, let's politely call them prescient.
Prescient is a very polite word for it. It is actually striking when you look at the charts. If we look at the on-chain data specifically for XRP, we see that on February 21st, which was just 2 days ago, well before any of this tariff news dropped, over 31 million XRP flowed directly into Binance in a single day.
31 million XRP. At the prices we were seeing back then, that's roughly $45 to $50 million.
Correct. And context is really key here. We track these exchange flows daily. A sudden, massive spike of that magnitude stands out like a sore thumb on the dashboard.
And who exactly was moving it? Was it just a bunch of retail traders getting spooked by something on Twitter?
No, absolutely not. We did a full cohort analysis, which basically means we look at the historical size and behavior of the specific wallets sending the funds. This wasn't retail. This wasn't mom and pop selling their 50 XRP to buy groceries for the week. These massive inflows came almost entirely from whale wallets holding 1 million plus XRP, and the tier just below that holding 100,000 to 1 million.
So the big institutional players. The whales. They moved their heavy bags onto the exchange a full 48 hours before the crash even started.
Which is almost universally a precursor to selling. You just don't move cold storage coins to a hot exchange wallet unless you actively plan to liquidate them or use them as collateral to hedge. They effectively loaded the gun before the target even appeared on the horizon. They clearly anticipated the drop, or perhaps they were pre-hedging against the tariff news that they strongly suspected was coming down the pipe.
That perfectly explains the initial selling pressure. You suddenly have $50 million worth of heavy sell orders hitting the books. But why did the price crash so incredibly hard? You mentioned thin liquidity earlier. Let's quantify that for the listener.
This is the critical second half of the mechanic. You have the heavy sell pressure incoming from the whales, but you fundamentally need buyers on the other side to absorb it. Spot trading volumes on Binance have reportedly plunged 95% since the January peaks.
95%. That implies the market is an absolute ghost town right now.
It means the order book is completely hollow. There are very, very few limit buy orders just sitting there waiting to catch the price if it falls. So when those whales suddenly decided to dump that $45 million worth of XRP, there was literally nobody on the other side of the trade to absorb it. The price naturally has to drop further and further down the chain to find a willing buyer.
It's like throwing a massive boulder into a shallow puddle versus throwing it into the ocean. In the ocean, it just makes a ripple. In a puddle, it splashes all the water completely out.
Exactly. And that massive splash is what triggers the robots, the auto-deleveraging, or ADL.
Okay, let's really unpack ADL, because I think a lot of listeners hear the word liquidation and they intuitively get it, but auto-deleveraging sounds like some sort of weird bank error. What is actually happening behind the scenes there?
It is the exchange's absolute last resort. It's a doomsday scenario for the matching engine. Normally, derivatives exchanges have an insurance fund. If a highly leveraged trader gets liquidated and technically loses more money than they actually have in their account, the insurance fund steps in to cover the difference, so the winning trader on the other side still gets paid out.
Right, so the overall system stays solvent.
Correct. But in a flash crash this violent, with spot liquidity this dangerously thin, the insurance funds can actually get fully depleted. Or the price just moves way too fast for the liquidation engine to catch up and sell the collateral. The exchange is suddenly staring at a massive, uncollateralized hole in their books, and they refuse to be left holding the bag. So the ADL system kicks in.
And what does it actually do to the users?
It forces the profitable traders on the opposite side of the trade to automatically close their positions just to balance the exchange's books.
Wait, hold on. So if I made the exact right bet, say I was aggressively shorting the market, correctly predicting this exact crash, my position might get forcibly closed by the exchange, even though I did everything perfectly right.
Yes, exactly that. You are sitting there, happily watching your profits grow as the market tanks, and suddenly, poof, your position is just closed out by the system. You get to keep your profit up to that exact millisecond, but you lose all your ongoing exposure. The system literally sacrifices the winning traders to pay for the losing traders' insolvency.
That feels incredibly unfair to the guy who called the top.
It is entirely about systemic survival for the exchange. But what it does to the market is it removes sell pressure from the shorts, or buy pressure from the longs, completely unpredictably. It creates a terrifying systemic cascade. Winning traders get knocked out, losing traders get violently wiped out, and the price just swings wildly in these massive arcs as the engine desperately tries to find mathematical equilibrium. That specific mechanism heavily contributes to those massive reality-breaking wicks we saw down to 77 cents.
That is honestly terrifying. It really highlights the hidden danger of using high leverage in a low-volume market. You aren't just betting against the market sentiment anymore, you're effectively betting against the software infrastructure of the exchange itself.
And the funding rates completely confirm this bearish chaos. XRP funding rates hit deeply, deeply negative levels today, hovering around negative 0.0748%.
Which means the shorts are actually paying the longs.
Yes. Usually, in a healthy bull market, longs pay shorts because everyone desperately wants to be long. When it flips this deeply negative, it means the market is overwhelmingly, aggressively betting on further downside. It is incredibly crowded on the short side right now. Absolutely everyone is piling in to bet on the crash continuing.
Which perfectly brings us to the XRP paradox, because if you were just casually reading the industry headlines today and totally ignoring the price charts, you probably think XRP was having the best week of its entire life.
It is the absolute classic good news, bad price scenario. And the headline today was objectively massive. Ripple's CEO, Brad Garlinghouse, was officially appointed to the CFTC Innovation Advisory Committee.
That sounds huge. The CFTC, the Commodity Futures Trading Commission, that's a major heavyweight U.S. regulator. Having the CEO of Ripple, a company that has been fiercely fighting SEC regulators in court for years, suddenly sitting on an official advisory committee, that's a literal seat at the table. That is pure legitimacy.
It is total institutional validation. It heavily signals regulatory normalization for the asset. Under normal conditions, it absolutely should have been a massive bullish signal. It implies that the long war is finally over and the institutional rebuilding phase has officially begun.
And for a hot minute, the market actually agreed, right?
Very briefly, yes. The price rallied sharply up to about $1.66 on the immediate news drop, but then sell the news phenomenon kicked in incredibly hard. The market makers used that sudden burst of retail liquidity, the people excitedly buying the headline, as the perfect exit liquidity for those exact whales we talked about earlier.
It's just brutal. It's like the good news just provided a soft, temporary cushion for the bad macro news to violently land on. And then, to make it worse, we have the major analysts piling on today. Standard Chartered. They've been pretty reliably bullish on crypto in the past, haven't they? I clearly remember them loudly calling for 100K Bitcoin way back when.
They have historically been one of the much more optimistic institutional voices in traditional finance, but they just issued a very significant reversal note to their clients. They slashed their end of 2026 XRP price target from $8 all the way down to $2.80.
Ouch. That is a massive haircut. From $8 to under $3. That fundamentally changes the entire investment thesis for a lot of macro funds. Why the sudden drastic change of heart from them?
Two very important words, capital rotation. Their lead analysts are arguing that smart money is actively moving out of the crypto ecosystem and directly into AI infrastructure.
Ah, the artificial intelligence narrative. NVIDIA, SMCI, the massive data centers.
Exactly. Think about it objectively from a massive fund manager's perspective. You have crypto, which is currently getting absolutely hammered by unpredictable tariffs and deep regulatory gridlock. And then right next to it, you have AI, which has very clear, explosive revenue models, massive predictable growth, and is currently the absolute darling of the global economy. Standard Chartered is basically saying, why gamble on a highly volatile asset class like crypto when the AI revolution is happening right now with real earnings in the equity markets?
So crypto is fundamentally losing the war for institutional attention.
It's definitely losing the war for speculative capital flows. Standard Chartered also specifically noted that actual institutional adoption of crypto utility is moving much slower than the industry hyped it up to be. The spot ETFs are finally here, sure, but the daily flows just aren't sustaining the price action.
Speaking of the ETFs, we do have spot XRP ETFs actively trading now. That was supposed to be the absolute holy grail for price appreciation. Are they helping buffer this at all?
They have seen respectable inflows, about $1.37 billion since launch. And look, that's not nothing. But recently, the momentum has completely stalled out. The buffer is gone. The daily ETF buying is nowhere near strong enough to absorb that massive whale dumping we mapped out earlier. 1.3 billion is a great start, but if multiple billions are simultaneously leaving via the spot market panics, the ETF structure simply cannot save the spot price.
So the whales are actively selling, the ETFs aren't buying enough to offset it, and the major bank analysts are downgrading the targets. But Standard Chartered didn't give up on the asset entirely, did they? I thought they still have a massive long-term target.
No, they didn't, and that's a very important piece of context for the listeners. They do still see $28 by the year 2030.
$28, okay. So they are basically just telling their clients, just wait 4 years.
Correct. But in crypto, 4 years is an absolute eternity. Their near-term optimism has completely evaporated. They're basically telling their institutional clients, look, it's going to be a very long, very cold winter before we get back to spring. Do not expect any fireworks in 2026.
And it's obviously not just XRP feeling the chill today. Bitcoin and Ethereum are the undisputed leaders of this space, and they are aggressively bleeding out right alongside it.
Bitcoin's technical damage on the chart today is severe. It clearly lost the 200-week moving average. That is a historic line in the sand for long-term macro trends. Losing that critical level officially puts BTC in bear market territory regarding its realized cap. It means the average holder across the entire network is now mathematically underwater.
And you mentioned earlier that whales are actively moving Bitcoin too right now. Is it the exact same dynamic as the XRP whales?
It's similar, but with a very concerning twist. We are seeing what we call old coins returning to active circulation. These are coins that literally haven't moved on the blockchain in 1, 3, or even 5 years. Long-term diamond hands are finally capitulating and selling. At the exact same time, short-term holders, the retail folks who bought the recent local pop, are panic selling and realizing their losses. It creates this toxic hybrid supply scenario where absolutely everyone, the grizzled veterans and the terrified newbies, is hitting the sell button at the exact same time.
That is a deadly combination for any order book. No wonder Standard Chartered aggressively cut their Bitcoin target, too.
They did. They walked it down from $150,000 in 2026 down to $100,000, which is still technically bullish from today's crash price, sure, but it's a very significant dampen on overall institutional expectations.
In Ethereum, it really feels like ETH just can't catch a single break lately. It's been severely lagging the rest of the market all year.
Ethereum definitely has its own highly specific drama playing out right now, the Vitalik factor.
Vitalik Buterin, the founder, what exactly did he do this time?
On-chain reports surfaced that he personally sold 1,694 ETH over the weekend. That translates to about $3.3 million.
Now, look, I have to play devil's advocate here for a second. In the grand scheme of Ethereum's total market cap, which is measured in the hundreds of billions of dollars, $3 million is literally nothing. It's a rounding error. It's a drop in the ocean. And the guy obviously has to pay real-world bills, right? He funds extensive ecosystem research. He donates heavily to charity. Why does this tiny sale actually matter to the market?
Mathematically, you are 100% correct. It is entirely negligible. It does not move the daily candle whatsoever. But psychologically, it is incredibly heavy. When the legendary founder of the protocol is seen actively selling right during a market crash, it sparks intense concern about internal confidence. It signals directly to the terrified retail trader, wait, if the genius who built this is selling right now, what does he know that I don't? Market sentiment is incredibly fragile right now, and even a mathematically small sale from a major figurehead gets massively magnified by the fear.
Yeah, it's entirely about the optics of the move.
Exactly. And meanwhile, the ETH price is painfully stuck below $2,000. It desperately needs to reclaim $2,600 to be even remotely considered bullish again. And right now, trading near 1860, that target just feels miles and miles away.
So we have flash crashes, massive whale selling, founder capitulation, and tariff shocks. Let's pivot and look at the other massive piece of the puzzle that was supposed to easily fix all of this for us. Washington regulation. We keep hearing nonstop about the Clarity Act. This was supposed to be the ultimate savior, right? The bipartisan bill that finally fixes market structure.
It was supposed to be the foundational framework that finally brings in the real trillions of institutional dollars. But right now, it is totally stuck in the Senate, and the clock is ticking incredibly loud. The White House explicitly set an end of February deadline for a legislative deal.
Which is, checking the calendar essentially right now. We are deep in the last week of February. If they don't pass it this week, what actually happens to the bill?
It highly likely gets permanently shelved until after the upcoming midterms, or it just gets stuck in endless committee purgatory. The partisan gridlock is fierce right now. And the absolute core conflict tearing the negotiations apart come down to one highly specific thing: stablecoin yield.
Okay, let's really unpack this for everyone. Why is yield such a massive sticking point? To an outsider, it seems like a very minor technical detail in a hugely comprehensive market bill.
It is definitely not minor to the legacy banking sector. To them, it's an existential threat. It has become an all-out lobbying battle between the mega banks and the native crypto industry. The banks are aggressively demanding a total legislative ban on stablecoins paying any yield or interest to holders.
Why? What are the banks so terrified of?
Deposit flight. Systemic deposit flight. Imagine you are just a regular, everyday person. You have a standard savings account at a major bank, let's say Chase or Wells Fargo, and they are paying you maybe 0.5% interest if you're incredibly lucky. Then you look over and see a regulated stablecoin like USDC, which is legally pegged 1-to-1 to the dollar, so it feels perfectly safe, and it's paying 3.5% yield or more purely from treasury backing. Where do you naturally put your money?
I put it in the 3.5% yield immediately. That's a total no-brainer for any consumer.
Exactly. And the massive banks know that perfectly well. They are absolutely terrified that if stablecoins are legally allowed to pass that yield onto retail users, literally trillions of dollars will rapidly leave their traditional balance sheets, leave their chief savings accounts, and move directly into the stablecoin ecosystem. It would severely drain the core liquidity of the entire traditional banking system. So they are lobbying incredibly hard to ban that yield entirely. They want to legally protect their historical moat.
And the crypto industry. Specifically, folks like Coinbase and Brian Armstrong, I have to assume they aren't just taking that lying down in the committee rooms.
Absolutely not. They outright refuse to publicly support any version of the bill that bans yield. They legally argue that USDC rewards aren't traditional banking deposits and that artificially banning them completely stifles American financial innovation. They are finally drawing a hard line in the sand. They are basically saying, we will not support a bill that deliberately cripples our best product just to synthetically protect the legacy banks.
So it's a total impasse, and the political rhetoric around this is getting really heated, isn't it? I heard Treasury Secretary Scott Bessent had some very choice words for the crypto lobby this morning.
Oh, that was definitely the political quote of the week. Bessent was visibly furious at the crypto lobby for stalling the passage of the bill over this yield issue. He literally called the crypto firms blocking the bill nihilists.
Nihilists. Wow, that's remarkably deep for a Treasury Secretary.
And he certainly didn't stop there. He went on record and said they should move to El Salvador if they don't like the U.S. banking rules.
Wow. Move to El Salvador. That is absolutely not standard diplomatic language from the Treasury. That is a direct, targeted insult.
It perfectly shows the extreme level of frustration currently boiling over in Washington. The Treasury desperately wants this bill passed immediately so they can finally regulate and control the market. The banks want it passed quickly to legally protect their retail deposits. The crypto industry desperately wants it passed to get operational clarity, but absolutely not if it kills their core future business model.
And the immediate implication for the listener trying to trade this market is painfully clear. The market actively hates uncertainty. Until this Clarity Act standoff is fully resolved, the real institutional money is just going to sit safely on the sidelines. They simply aren't going to pour billions of dollars of client capital into a market where the fundamental rules might drastically change tomorrow, or where the U.S. Treasury Secretary is actively telling the industry leaders to pack up and move to Central America.
Exactly. Severe regulatory gridlock acts as a massive liquidity dampener. It suffocates growth.
So if we look at the board, we have a pretty grim picture painted here today. We've got sudden global tariffs, a massive leverage crash, and deep regulatory gridlock. But, and there is almost always a but in crypto analysis, we have to actively look for the other side of the trade. Are there any contrarian signals out there right now? Are we seeing anything in the data that suggests we might actually be nearing a tradable bottom?
Yes, there actually are a few fascinating signals flashing that suggest we might be witnessing peak capitulation right now. And strangely enough, if you study market cycles, deep capitulation is very often a necessary, healthy thing for finally finding a firm bottom.
Explain that logic. Why is it inherently a good thing that retail investors are giving up and quitting?
We specifically look at a very reliable on-chain metric called realized losses. This explicitly tracks when coins are moved on the blockchain at a price significantly lower than they were originally acquired for. It means the holder couldn't take the pain anymore, actually clicked sell, and permanently took the financial loss. They locked it in.
Okay, I follow.
Well, XRP just officially recorded its single largest spike in realized losses since 2022. The weekly realized losses just hit an astonishing $908 million.
The everyday people literally locked in almost $1 billion in pure unrecoverable losses. That is incredibly painful to think about.
It is incredibly devastatingly painful for those specific individuals who hit the button. But for the overall macro market structure, it acts as a massive system cleanse. The last time realized losses were consistently this high was back in November 2022, right during the chaotic depths of the FTX crash.
Which was the absolute undeniable bottom of the last major cycle.
Precisely. And do you remember what happened immediately after that historic flush? XRP actually rallied 114% over the following 8 months.
That is really interesting context. So the core contrarian theory is incredibly high realized losses mean all the so-called weak hands are finally gone.
Exactly. When absolutely everyone who is scared enough to sell has already panic sold, there's literally nobody left to press the sell button. The downward momentum exhausts itself simply because there are no more willing sellers left in the order books. At that point, the only path of least resistance is up.
What about the actual underlying activity on the network? Is anyone out there actually using the XRP ledger for anything, or is absolutely everyone just blindly moving it to Binance to dump it?
That is the second major contrarian signal we are tracking today. The active addresses on the XRP ledger actually saw a massive spike. They fully doubled, from around 17,000 to roughly 32,000 active addresses right during the worst of this crash.
Doubled. while the price was violently collapsing.
Yes. Now look, we have to be realistic and careful with the interpretation here. A good chunk of that surge is highly likely just panic, selling people dusting off old wallets, moving their dormant coins to hot exchanges just to dump them. But historically speaking, intensely high network activity very often precedes a major volatility resolution. A completely dead network with no activity is what's truly bearish. A highly busy network, even if it's currently busy with sheer panic, shows there is still a very strong pulse. There are real people actively engaging with the chain infrastructure.
Right, I guess any heavy volume is objectively better than total silence.
Much better. It proves the plumbing still works under stress.
But I suppose we really have to balance that optimistic bottom signal against the AI rotation narrative you mentioned earlier. That seems to be the really heavy, fundamental counter-argument keeping prices suppressed.
Yes, and that is unquestionably the massive elephant in the room right now. The broader Wall Street narrative has definitively shifted this quarter. The prevailing attitude is very much crypto is out, AI is in. Sophisticated investors are looking at NVIDIA earnings, they are looking at massive AI data center infrastructure buildouts, and they are seeing incredibly clear, highly scalable revenue models. Crypto desperately needs a brand new utility narrative right now to actively compete with that kind of predictable cash flow.
It really feels like it can't just be the digital gold pitch anymore. That particular story is getting really stale for traditional investors if the crypto price just violently drops every single time the Nasdaq wobbles.
No, it absolutely can't. It actively needs to be useful in the real world now. It needs to publicly show real auditable revenue generation. That's exactly why that stablecoin yield fight in Washington is so incredibly important for the whole space. That yield represents actual tangible utility that everyday people can instantly understand and benefit from.
So, as we are looking ahead to the rest of the week, let's talk actionable strategies. What should our listeners be closely watching? If they are sitting at home staring at their trading screens, what are the absolute key levels they need to set alerts for?
For Bitcoin, the ultimate line in the sand is that $60,000 to $62,000 zone. It absolutely must hold on the daily close. We are hovering currently around 64,000. If that 60,000 level cleanly breaks on high volume, the technical charts open up a terrifying drop straight down to 50,000. There's very, very little historical support in between those two numbers.
Man, that would be another brutal 20% drop from here. And what about for XRP?
XRP urgently needs to reclaim the $1.40 to $1.50 range, and it needs to do it quickly. That zone was the previous heavy support. It needs to fight back and turn that resistance back into a reliable floor. If it stays suppressed below that level for too long, $1.11 is the next major technical floor. And if it drops below that, well, let's really just hope $1.11 holds firmly, or we're very realistically staring at sub-dollar prices for a while.
And are there any major macro events on the calendar later this week that could potentially turn this entire ship around? Or are we really just waiting for the general vibe to organically improve?
There are actually two very big hard data events to watch. First, the Supreme Court ruling. It is highly expected to drop this Friday, and it directly regards President Trump's executive tariff powers.
Right, there is that massive ongoing lawsuit aggressively challenging his legal ability to unilaterally raise these tariffs without explicit approval from Congress.
Exactly. If the Supreme Court rules against him on Friday and actively limits his executive power to impose these sweeping 15% tariffs,
That would be absolutely huge for the markets.
it would be a massive, immediate relief signal across all asset classes. The broader market would highly likely rally hard because it instantly removes that looming inflationary pressure we talked about. It takes the heavy boot right off the neck of the global economy. But conversely, if the court definitively upholds his tariff authority, we could easily see another violent leg down as the reality of sustained inflation fully prices in.
And what is the second major event to watch?
The FOMC Fed minutes release. We are deeply scrutinizing them for any forward-looking inflation data, and critically, any subtle hint of how the Fed is internally handling this rumor of the independence crisis. We desperately want to see if the internal committee language reflects the external panic we're seeing on Wall Street today.
So, final strategic thoughts for the listener. How do they actually navigate this absolute minefield of a week?
We are firmly in a trader's market right now, absolutely not a holder's market. The passive buy and hold strategy is incredibly painful in this specific environment because the intraday volatility is just so absurdly high. You have to be highly nimble, protect your capital, and respect your stop losses.
And what about the old idea that crypto is fundamentally decoupled from the traditional stock market? Can we finally permanently put that to bed after today?
The decoupling myth is completely dead, buried deep. When the macroeconomy sneezes like when massive global tariffs hit, the wire crypto violently catches a cold. It is currently acting as a high beta risk asset. It moves generally with the NASDAQ, just with significantly more explosive volatility in both directions.
Is there any long-term silver lining here? Please give us something somewhat positive to end this on.
The real silver lining is the underlying infrastructure. The RLUSD stablecoin from Ripple is actively being built and tested. The massive institutional spot ETFs exist and are trading daily. The deep institutional plumbing is literally being installed right now, even if today's panic price isn't rationally reflecting it yet. BlackRock isn't packing up and leaving the space. Standard Chartered isn't leaving the space. They're just rationally lowering their short-term price targets to reflect the macro headwinds. If you truly have a long time horizon, if you can mentally look past the chaos of 2026, that fundamental build-out really matters. The structural rails for the future of finance are actively being laid down while everyone else is panicking.
Okay, let's wrap this up. It's definitely been a very heavy episode, but a crucial one. We clearly had a perfect storm of surprise tariffs, unprecedented political chaos at the Fed, and excessive leverage that just completely flushed the market today.
Indeed, we did. But I actually want to leave you and the listener with one final, perhaps highly provocative thought to chew on.
Go for it. Scare us a little bit more before we sign off.
Look, absolutely everyone is hyper-focused on the crypto price dropping today, specifically because of the tariff news and the resulting strong dollar. But really consider this macro scenario. If this Federal Reserve crisis deepens, if that criminal investigation rumor turns out to be entirely real, and the U.S. dollar actually structurally weakens globally because of that massive loss of institutional trust, and simultaneously we see traditional gold rising as a safe haven, we have to ask ourselves a very hard, very uncomfortable question about Bitcoin.
Which is what?
Is Bitcoin fundamentally failing as a reliable store of value in a true systemic crisis? Because if the U.S. dollar is under severe existential threat, the core narrative says Bitcoin should be skyrocketing right alongside physical gold. But right now, it's crashing. So is it actually digital gold? Or has it just slowly morphed into a highly leveraged tech stock that happens to trade 24/7? Because if it consistently crashes alongside risky tech equities while gold rises to the occasion, we might seriously need to rethink the entire digital gold thesis that has aggressively driven this entire industry for a decade.
Wow. That is a very heavy thought to chew on. Is it genuinely digital gold, or is it just another volatile tech stock? I think the industry will be actively debating that exact question for a very long time.
I heavily suspect we will. It's the ultimate identity crisis of the entire asset class.
All right, everyone. Stay extremely cool out there. Watch that 60K level on Bitcoin like a hawk this week. Absolutely do not use leverage if you can't handle this kind of heat. And please remember, sheer panic is rarely a profitable strategy. We'll see you in the next deep dive.
Stay informed.